Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's May 24th, 2019, episode 29. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week.
This show is broadcast as both an audio podcast and as a video on YouTube. So if you're enjoying this as a podcast and you feel like you're missing out on the charts and videos we're referencing, you can register at the markethuddle.com website or get the weekly emails, which include the chart pack and video links, or just flip over to YouTube. Also, don't forget, if you don't want the full Huddle episode, there is now a new Market Huddle segments version, which breaks up the podcast into the different parts, and that's available on iTunes, Android Play, Podbean, and Spotify. So just search for them, Market Huddle segments.
This week, we welcome Adam Collins from Movement Capital, and then Patrick gives me a lesson in the dark art of technical analysis.
And in this week's trading history, we go back 300 years to England to discuss the South Sea bubble.
For our WTF video, we learn about a LA real estate developer who is all in. And then we end with the 5 most important things to watch next week.
All right, so let's jump into it. Who's the show brought to us this week by, Kev?
Well, Patrick, you forgot to introduce Lena. Lena,
hello.
Welcome to the Market Huddle. Great to have you again.
Thank you.
So this week we're getting Kapow IPA. I thought it was a very fitting name.
Right.
The market feels like we've been getting a lot of Kapows lately. So this, once again, I've noticed that the reviews hint about some pine taste in it. So let's open it up and see if it's pine or spruce.
This is a 6.5% alcohol. This is one that will give you a good buzz.
Yeah,
it's not sessionable.
It's also labeled strong beer.
It's actually not that bad. It's definitely an IPA. You got that hoppiness for sure.
What do you think, Lena?
I think it's very similar to the one we drank last week, but this is good. It's got like a fruity taste, but it's definitely hoppy.
So is it more spruce or pine?
I think it's more mango.
The mango tree. Okay.
All right, give us your disclaimer here, Kev.
Let me do my disclaimer stuff. Okay, clients and employees of East West Investment Management may hold positions in securities mentioned in the podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much Market Huddle may include Jaegerophobia, petulant
what the hell is that?
agita, too much Jaeger, petulant agita, more commonly known as a food baby, and or alcohol-related spontaneous combustion.
Oh shit!
Yeah.
I might suffer from that one.
That's like from Spinal Tap. It's an offshoot of the Spinal Tap.
All right.
Okay.
Well, thanks for that. That disclaimer is so important for our listeners to know in advance before they listen to the episode.
That's right.
But anyway, time to move on.
Let me take over here because Adam's actually one of my buddies that I've kind of had the pleasure of knowing for a long time. And although we've chatted a lot of times on Twitter and by email, I've never had the pleasure to meet him in person. So this is a really great kind of opportunity for me. So Adam, welcome to the Market Huddle.
Yeah, thanks a ton. I'm definitely happy to be here.
So today, for those who don't know Adam is, first of all, Adam, you are a millennial, right? Considering that I see your expertise in terms of your beautiful websites. And I said, you sent me a blog post the other day, and I said, this has got to be the most, I hadn't read it yet, but I said, I looked at it, and I said, this is the most visually pleasing web post I have ever seen. So it's absolutely just beautiful stuff. And from someone who has to write and do those things, I really appreciate it. But for those who don't know, Adam kind of focuses on the COT, the Commitment of Traders report. And that's how I first kind of came upon your stuff. And
Yep.
and I know you. And for those who don't know what a COT is, it's basically shows whether the speculators or the hedgers are long or short a particular commodity. So you've been kind enough to produce a slide deck for us with some of your information and stuff. So I was just wondering what's on your mind and what you want to talk about today.
Yeah, for sure. The whole thing about, COT is, I think there's more nuance to it than, at first glance. A lot of people look at a COT report, and for example, what you're looking at is this shows basically different trader categories like, money managers or commercial hedgers, and it shows how many futures contracts they are long or short. And the whole reason why I started working with COT is because years ago, between my sophomore and junior years of college, I wasn't like 100% sure if I wanted to go into finance. So I took a year off and I worked for a fund, and it was a small CTA. And on like the first day, he looked at me and he was like, "Hey, I think the COT report matters. Like, I want to be able to see how other traders are positioned. The raw format on the website is really ugly. So let's make this look pretty. Let's make it actionable, right?" And so that's what I did. That's what my website, which is free, basically does. And the whole thing with COT is that you don't just need to know, current positioning. You need to know whether it is extreme or not relative to the past. So for example, with this chart on the screen right now, like a current report, yeah, I mean, maybe you see that money managers are leaning really net short corn, but you need to know if that's historically extreme or not. And some other things to know quickly before we go to the next stuff is that, like, there's some very common pitfalls I see time and time again with COT. Probably the biggest one is just looking at nominal positioning, aka just like the number of contracts. And so we've all seen that very scary chart rotating on Twitter, which is the spec position in VIX futures, right? And it's a chart that sort of, it hugs the zero line for forever, it explodes downward. The takeaway is get scared, everybody's short VIX. And the reality of it is that VIX futures, pre-2004, they didn't exist. And for basically 5 years, nobody traded them. And so if you're just looking at nominal positioning, it's going to be this minuscule number because it was a very small market. But the market has massively grown. The open interest went from 50,000 to 500,000, and therefore just the total position sizes are bigger. But that doesn't necessarily mean that people are running more concentrated positions. And so I think that's the first main issue, is you have to scale positioning by the size of the market. So it's sort of like an accurate read. And the second thing is that I think too often people like apply COT analysis, sort of like a blanket across all markets. And the truth of it is that it's really relevant for some markets and that it's less so for others. And the answer is that, futures are the primary sort of vehicle or exchange for commodities, right? But when it comes to stuff like bonds or FX or stocks, futures on those contracts are a sliver of the total market. So for example, if you're looking at COT data on currencies, that is completely ignoring like the spot FX market. And then also with like bonds, let's say you're looking at positioning for like the 10-year note, that's only showing that isolated contract, and it completely ignores, people spreading twos, tens, et cetera. And so I would say that personally, you should assign more weight to COT for the markets where that's sort of like the entire market, like commodities, and maybe sort of discount it a little bit for the financial stuff. And then I would say third thing about COT really quick, which is everybody's gut reaction to seeing COT data where like, specs are super short, super long, is to fade it, right? Because you hear, traders are super long WTI, I'm going to, flip it other side of the boat and be the contrarian in the room. But you have to think about whether that makes sense or not, because ultimately crowded positioning does not resolve itself until people have a catalyst for actually liquidating their position. So for example, I think it was 2017, people wrote about WTI being this super crowded long for forever, but like put yourself in the mind of somebody who was long crude. Like it was steadily grinding higher. They were not under pressure. So regardless of like the positioning size, people were in the money and didn't have an incentive to liquidate. And so to me, with not just COT data, but any sort of positioning data, it becomes most relevant when you can sort of combine crowded positioning with price action that is putting those people under pressure and actually forcing them to, run out of the theater when like somebody else fire. And so to me, extreme positioning isn't enough. you have to sort of contrast it with, okay, is price action like helping them or hurting them? So anyways, that was just sort of like main three pitfalls I think people should know. But let's dive further into the graphs and such. So this next chart is, so this is still the same commodity. It's corn, but it's showing you that net, money manager position as a percentage of, actually this is showing in dollars. So what I'm doing is I'm taking the net position, I'm multiplying it by the front month and then by the contract multiplier. And the whole point of this graph is just giving you some context, right? So like, is positioning historically extreme, yes or no? And the answer is definitely yes for corn. Traders got really, really bearish on corn over the past few months, and you can see how that has not worked in their favor. And recent price action has definitely been hurting people who have leaned heavily into short corn. And then we got some other stuff, I think, like what's next? We got, okay, so this is the metric I made a site out of, which is all it is a 5-year percentile. So it's taken that net position, scaled by open interest, and then scaling it into a percentile. Because, for example, let's say you come to me and you say, okay, traders are net long 20% of the open interest in palladium. I don't know, like it might sound like, they're sort of long, but I don't know the actual historical range of that number. So I sort of normalize the positioning across all the contracts with a percentile. Other people do this with a Z index. It's very similar. And the easy way to, the reason why I do it is because basically if you're at, 100%, it means that category, hasn't been that net long over the past 5 years. And if they're at 0%, it means that they haven't had that low of a position. And so it's an easy way to sort of cross compare, across contracts. And
right.
so,
like Adam, I'm gonna jump in here because I just wanted to point out to everybody, it's Kevin here, and this is the example of the terrific charts that you can get on Adam's site, and you can get this for free. And this analysis is done on your website. Why don't we, while we're talking about this, why don't we tell people where, if they want to go do their own analysis on different commodities, where they would find that?
Yeah, for sure. So all the charts are completely free, and it's at freecotdata.com.
Right. And this is the kind of charts that you can get there. And it's been a great resource, and I really highly recommend that everybody go there and have a look at it. I was laughing when you told the story about the VIX future. I couldn't help but think to myself, but that isn't the VIX future all the guys that are short? That would be Patrick's favorite website. They would post that all the time.
Oh, for sure.
And the fact that, the zero hedge, that's the kind of stuff that they'll post, and you don't realize that just looking at it, there's a lot more to it than just kind of looking at the absolute numbers. The other thing that I think people don't kind of take into account, and I'm so happy you did it with the corn, is the dollar value.
Yep.
Because you can't just put it in contracts. Like, for example, WTI, when everybody is long, when the oil is $110 versus when it was 25, it was a lot different.
Yeah, it should be even double, triple, quadruple the amount, right?
Yeah, for sure.
Right. So looking at it, so I think that this is an interesting way of looking at it. But I interrupted you, Adam. Why don't you continue on with your with the different charts you have for us?
No, yeah, no worries. Let's see what we got next. After this one, we got, in fact, speaking of WTI, this is where positioning stands with it. And now this is showing on that left-hand side, you can see this is the percent of open interest. So like right now, specs are net long. What is that? 20% of the OI, which is, it's definitely up there. But remember, it's like you can't stop the analysis there. Like look at 2017, WTI specs were very long for a very long amount of time. And it didn't really matter until WTI started puking, putting them under pressure, and then it was sort of like a rug pull, and they sort of ran for the exits. And so honestly, recent price action in WTI, that definitely does put the consensus, net long in WTI under pressure.
Right.
And then let's see what we got.
Yeah.
Okay, so this is yen. This is probably the most interesting FX chart to me in that it came back a little bit recently, but this has been sort of the one currency against the USD where specs were like uniformly quite net short. It was honestly this and the Swiss franc, and so there's sort of like that common thread of safe haven. And this was sort of interesting to me. And Horseman Capital has written a lot about the yen being, fundamentally undervalued, and they've got some interesting reading there. And so when you start to combine, credit short positioning, fundamental, undervaluation, et cetera, then you can sort of form a thesis.
Okay,
So,
so actually, let's. Oh, sorry, Patrick. I didn't mean to kind of
Yeah.
cut. We both jumped in there because we were excited about it. So,
Yeah,
Horseman Capital. They've been talking about the yen being undervalued. Like they think that it's headed higher.
Well, so they've written a lot about Japan, and when they've talked about, the currency specifically, they talk about how it would really be a bad thing for all the Japanese exporters if the yen sort of started to trade a bit richer, right? And on a bunch of different bases like purchasing power parity, real exchange rate, et cetera, yen is historically cheap against the USD. And what they're sort of saying is that, like, if that reverts to the mean, that is not going to be a great thing for the export-centric, Japanese economy.
Right. And so now you're arguing that there's a lot of shorts out there and that we've been kind of consistently, everybody's been shorted on the spec community. And so therefore the potential for a problem like an accident the other way with the yen rising, is that what you're kind of highlighting and saying this is a risk?
What I'm saying is basically corroborating with what Horseman is saying, in that, like, they're approaching it from, they've had some fundamental charts about it. I'm approaching it from a point of view. And by the way, it's always very confusing with FX futures because it's always the opposite of the traditional currency cross. This is JPY over USD, not the typical USD JPY, which is what most people look at. For some reason, the CME contracts are like this. But what I'm saying is that most traders are short the yen against the dollar. And if, let's say you sort of like, see the yen strengthen against the dollar, that would catch the majority of like the spec community offside, since they're sort of like leaning short against the yen.
Right.
So Adam, I wanted to just ask you, like, I understand in the commodity markets because the futures tend to reflect the majority of the trading volume. But when we're talking about futures on a currency, there's often far more transactions occurring in the Forex markets
sure.
Than there are in the futures. And have you seen this cause a divergence in the data, the fact that the futures are a smaller component? Is it still enough sentiment to be able to more accurately see how everyone in the much bigger picture is positioned?
Yeah, I think that in general, I've sort of watched COT and seen how it sort of correlates to other position, ways to track positioning, be it like bank surveys and stuff like that. And more often than not, it ebbs and flows in the same direction. But like I said early on, like, one of the pitfalls is to read too much into COT where the contract, futures aren't the primary market. And that definitely does apply to any FX. And so it's sort of like,
Right.
I note this, but I take it with a grain of salt. But continue to what we got next. So we got yen, then we got, I'll just quickly go through this. That yen chart, the previous one, that's just a 5-year percentile. So all it is scaling it based off of 5-year data. And then go to that next one, gold. Everybody likes to talk about gold. Gold positioning, there's not much to talk about. And that's the truth about COT. Very rarely is there truly extreme positioning, right? More often than not, it's just sort of like in the middle of its historical range. And that's sort of the case with gold. There was definitely a period in, mid 2018 where positioning was uniformly bearish gold. In fact, it was the first time in like 12 years that traders got net short gold futures. But that's not the case now. Traders are net long like 17 billion or so. And so if anybody comes to you and says, futures traders are offside gold, that's not really the case. I would say position's a wash.
Well, it's a wash here, yeah.
Yeah.
How about this chart over here?
Yeah. So what this does
equity
is
markets.
This combines both the E-mini S&P, E-mini NASDAQ, and E-mini Dow, multiplies them all by the contract multiplier, then puts the dollar value on it. And here's this is a nuts chart to me in like 3 ways. The first way is that traders in late 2015, early 2016 got more bearish on U.S. equity futures than they did in 2008, which is a crazy statistic. And then you can see what sort of happened, which is when the market bottomed in Feb 2016, they were very reluctant to reestablish that net long. It took a while for the positioning to sort of bleed away. But then it sort of like truly had a blow off top in January of 2018 when their net long position in dollars eclipsed 120 billion, which is a large number. And so, they basically went all in Jan 2018, got a little bit spooked after, Feb 2018. But then as 2018 progressed, you can see they got more bearish, and it's not like they threw in the towel, but they pulled a lot of long exposure in Q4 last year. And here's the nuts thing. Look at this. So obviously we're up, whatever it is, 15, 20% off the lows. Positioning has not come back. They're still net long, but not to the extent of, where we were higher price levels ago.
Adam, this is a fantastic chart. I think it's awesome, and it's unbelievable. If you look at this, you realize that they've sold $100 billion of stock since that period, and yet the stock market is actually higher.
Yeah.
And I fight with Patrick about this all the time because he tells me that most people are bullish and that there's all this that when I see the bearishness in the FinTwit community, I'm just looking at an elite few. And I think that this is kind of backing up my belief that there is no kind of rampant speculation in the stock market, yet it continues higher.
Yeah. And to me, it's a tricky thing of think about those people who have puked and think about if we make all-time highs, what do they do? So they're going to get back long. And to me, it's like, I don't know, this chart. It's a thing of where in Jan 2018, that's a true thing. That's a point in time where Zero Hedge could absolutely put out a piece and be like, hey, leverage traders are all in. This is crazy nuts positioning. That was the case then, and it's not the case now. And this is it's pretty good chart.
And actually, one second, Patrick,
I will make it. Yeah,
sorry. I just want to point one thing out as well. You're highlighting that January 2018 kind of climax long position, but look at where it came from in 2016. They were actually net short 20 billion. So between January of 2016 and January of 2018. During those 2 years, speculators bought like $140 billion of, U.S. equity futures. And like I remember that January well. It was just madness, and it was like the just get me in. Like that's what it felt like,
sure.
and your data's showing it. Patrick, you wanted to say something?
Well, I was just gonna let's circle back over here on the same chart to 2007, 2008 into 2009. This whole sequence, and what do you see there? Because to me, when I'm looking at this that data, that seems a bit of a muddle on the data there.
So it's a very ugly chart for speculators. This out. Basically, what it's showing is that in early 2009, late 2008, before the market bottomed, speculators actually sort of faded that. And they added on their net long position from 30 billion to 50 billion, right? And then the bottom fell out of the market, finally bottomed. But you can see they capitulated sort of when that happened.
Yeah.
And they were definitely caught off sides in late 08, early 09.
Right. No, see, like Kev, where I would take the opposite stance of you, and Adam, feel free to share your view on this as well. But my argument all along is very much on the camp of like the David Rosenbergs, which is actually it was January, February of 2018 that was really already the top of the bull market. And that blow off right there was just exemplifying the extreme. And all of these market highs that we've seen are just retesting those highs in what is a big topping formation. Now, maybe the S&P did poke its head a little bit of a higher high along the way, but to me, I see the fact that blow off top in 2018 was exactly that, and that this is in fact just the fact that the price or the orange line is consolidating is actually potentially maybe supporting the fact that there is no bull market in place anymore.
Well, Adam, I'll let you go.
Adam, push back on me.
Okay, so I'd say this. I'd say first off, this chart we're looking at. It is but one thing in the infinitely complex puzzle of markets. So positioning to me is not the end all be all. But I will say this: the relationship between price action and positioning it's sort of a push-pull of where, okay, let's say, let's think about this. If S&P broke all-time highs, what's going to happen? You're going to have people who are sort of less net long. They're less net long now than where they were at similar price levels, right? So there's going to be this like vortex of like, sucking people back in. But to Patrick's point, if you have a situation where, let's say, we don't eclipse all-time highs, and these people who were reluctant to put on long exposure, they become vindicated, and maybe that bearishness sort of infects others. And right now with specs net long, let's say 50 billion, that is, it should never be classified as like bearish positioning at all. In fact, you can see that it's historically been a lot lower. And so to me, how traders are positioned in equity futures is not extreme either way, not up or down. And the ultimate sort of thing is, if you clear all-time highs, you've got a lot of money that's probably going to get sucked back in. But if you sort of drip lower, specs can obviously just revert back to being net short like in late 2015.
Well,
Right.
Adam, you did a terrific job of not letting Patrick's bearishness affect you. Why don't you go on with the next chart there?
Oh, for sure. In fact, because I know y'all want to fit it in a window, let's go ahead and jump to the hedging stuff. So like COT, I could talk about that for forever. Okay, this is sort of a research project I did, which is, we've all heard, articles being like spot VIX is low, insurance is cheap. So like, why not add on some puts, some hedges? And I sat back and said, okay, that intuitively sounds correct, but how has it actually done? And so what this chart does is it's comparing sort of three different hedging strategies. So let's say you take a portfolio that's 97.5% the S&P and then 2.5% a hedge. Now the hedge is a 6-month, 10% out of the money put owned SPY. And the reason why there's a bunch of different lines is because I show different sort of strike distances: 10% out of the money, 20%, and 30%. Main takeaway there is strike selection really doesn't matter. And so what this chart shows is, if you were to roll that hedge every single quarter, how would it impact both your compound returns on the left and then the whole portfolio drawdown on the right? And I would say there's sort of two things that stand out. One, which is on the left-hand side, a 2.5% hedge sounds like a very small fraction of a portfolio. But if you get a year, like let's say, 2017, where markets constantly rip higher, and you sort of, let's say you're constantly, rolling that hedge. Some people even do it monthly, but this sort of scenario is just rolling quarterly. A 2.5% hedge can vaporize 10% of a portfolio if you re-roll it every quarter and all of that premium bleeds out, right? And so the graph on the left is meant to convey, hey, this isn't just a really small slice of a portfolio. This can really be a material drag. And then the chart on the right is meant to show, okay, even if you did nail your timing, and let's say you did, allocate some money to a hedge, it's not as if it transforms, an S&P drawdown from negative 55% to negative 20%. You're still in a monster drawdown. And if you go to the chart after this sort of changes it for a bigger budget. So let's say somebody comes to you and says, okay, I'm going to run 95% long S&P, 5% in a put hedge. How's it worked, right? It has transformed the market in U.S. history into essentially flat performance. A 5% hedge budget is monster. And specifically, this is a static hedged budget. So if we go to the charts to the right, let's see what's next. The graph after this one. Okay, so this is putting some hard numbers on, okay, how has this yearly P&L in different years? So I've sort of contrasted. I got, best year ever to have a hedge, 2008, horrible year, 2013, mixed year, 2018. You can see that let's say like a 5% hedge, right, 30, 20, or even 10% out of the money, it definitely helped in 2008. It cut the 37% year-end loss into basically a 20% loss. But by that same token, it obviously cost you a lot in 2013. It transformed a 30% up year into like 11% up year. It's because with a 5% quarterly hedge budget in a year like 2013, where the market's always going up, you're bleeding a lot more than 5% total in your portfolio. The graph, or the next chart, what it'll show is let's see. Okay, so a lot of people hear that analysis and say, Adam, I'm not talking about, always applying a hedge. I'm going to selectively do this. I'm going to only do this when it makes sense. And so a lot of people jump to using the VIX as a filter. And they say, hey, let's say I only hedged if spot VIX was less than 15. And this is showing that 10% out of the money hedge. And what it shows is that on the left-hand side, it's sort of like in the middle of the performance between 100% long S&P, always having to hedge, and then like selectively applying it when volatility is cheap. But here's the interesting thing about it is that if you wanted to run a hedge strategy, to me, implicitly, it would have to be designed in a way that catches big drawdowns like 2008. But when you have a sort of like a cheap volatility filter, that would have called for never hedging in 2008 because volatility was always elevated, right? And so the issue with doing some sort of like black white filter for like when vol is cheap or not is that I can assure you in September 2008 spot VIX 30, assessing that at face value, volatility was rich relative to history, right? But then that 30 VIX ended up being quite cheap relative to the realized of 70 in October. And so to me, using volatility being cheap or not to sort of influence whether you're hedged or not has done a really crappy job at giving you exposure to the hedge when it's been necessary, be it '08, be it 2015, 2016, or even like last quarter. And so this is hedging based on VIX. The next one, some people say, okay, I don't want to hedge based on VIX. I want to hedge based on valuation. So let's go back one. So this is just applying a hedge, whether CAPE is greater than 25, a rich market, or less than 25. And so implicitly, you're sort of saying, hey, richly valued. Here's the tricky thing. When markets really correct, it's not as if they touch fair value and bounce. They get fairly valued, and then valuations implode, and it becomes a truly cheap market, right? And so if this would have been your hedging criteria in '08, you would have taken off a hedge well before, the October volatility because markets got cheap in like, Q2 and Q3 of '08. And so to me, these are not sort of like the data is not on the side for selectively applying a hedge based on valuations or VIX because it always would have called for sort of taking the hedge off when it didn't make sense. And I hope that sort of made sense.
So, Adam, I'm going to just ask you for our listeners to add some clarification because so when you're going 10% out of the money, not always is the hedge 2.5%. Like, are you just basically spending 2.5% of your portfolio to buying a hedge that is so just for simplicity, let's say the S&P is at 3,000, you're going 10% out of the money at 2,700. You're spending 2.5% of your capital to buy those puts. Is
Correct.
that what you're
That's
implying?
it. So here's sort of the hedge in motion, and I should have explained this. Was like, let's say it's January 1, and let's say we're talking about the static hedge, no timing. If it's January 1, and let's say, because I buy everything on SPY, if SPY is trading something like 300, you go 10% out of the money to 270 strike. And remember, I'm going 6 months out. So if it's January, I'm heading out to like June or July puts. Okay, so I would be spending 2.5% of portfolio capital on the hedge and keeping that exact maturity and strike for 1 quarter. Then let's say it rolls around to the end of Q1. It's like the last trading day in March. Then let's say SPY had gone down to like 250. I would roll the strike down to 225, and then I would roll the maturity out to a September put. And so, but then you're sort of resetting the 2.5%. So like, if at the end of March, let's say the hedge did really well and it ballooned to like 5% of the portfolio, then you're sort of taking profits on that, and then you're only rolling 2.5% into the fresh hedge. And then if the hedge did like really bad in the quarter, you're sort of re-upping from like a 0% to allocating new capital to the hedge budget, if that makes sense.
Right.
Yeah, Adam, that's terrific stuff. And, as a former index trader, I can tell you it makes complete sense because we used to sell that shit all the time.
Yeah.
It's always overpriced. And I think you've just done a terrific job of kind of putting it into numbers in terms of like how little that hedge works, and how much it's not really going to save you when the shit really hits the fan. And not only that, it's very difficult to kind of trade it correctly. Anyways, Adam, for those who want to stick around and learn more about Adam, make sure you stay to the after hours. In the meantime, before we say goodbye to you, Adam, why don't you tell people where they can find you, a little bit about your company, what they can do, and how they can contact you?
Yeah, for sure. So main avenue is through Twitter, movement_cap. Movement Capital, that's actually where I manage, outside capital. And those type portfolios, a lot of people think I'm like super short term, like using COT for like intraday stuff. I am not that at all. I manage more boring ETF portfolios for like individual investors in the US. And that's what I do with Movement Capital. And I guess that website is movement.capital. And then, like I said, I do have all those free resources for traders. I've got the COT website, which is free, cotdata.com, which is, just positioning. And then for people who like to look at seasonals, I've got commodityseasonality.com, which shows you free seasonals for a bunch of commodity contracts.
Well, thanks for being on, Adam. It's been terrific chatting with you. And for those who want to, hear more about what Adam's got to say, maybe we'll even delve into the seasonality of some different commodities. Stick around for the after hours with Adam. Thanks again, Adam.
Yeah, I enjoyed it.
So, Patrick, it's time for the second segment of our kind of beginning part of our show. And I wanted to spend some time, and I want a lesson, Patrick. I want a lesson in the dark arts of technical analysis.
Oh, my God.
Before we do, actually, I got to do something.
By the way, for full disclosure here, this has not been pre-prepped. I have no idea where you're going with this.
That's correct.
Let's see what you got up your sleeve.
So let's start with the first chart here. Let's pull it up.
Okay.
So, Patrick, buy or sell this index?
Buy.
Oh, you bastard. You know what it is.
This is just an inverted chart of the S&P.
Ah, you bugger. I was trying to figure out something. Okay, so yes, you're right. I inverted the S&P, and because I thought to myself, I don't understand.
I instantly saw when I saw what chart did he pull up. I go, he just inverted the S&P. I knew because
okay. So
it's the dark art. It's a dark art.
It's you know what? You're good, man. You're like Voldemort. That's what you're like. So what I want to know is let's go let's talk about this, Patrick, because I'm confused by it. And I'm confused by why all the technical analysts out there are short. And I'm not saying this as a joke. I'm not trying to get you.
Yeah.
I am confused because I look at this thing, and why don't you pull up kind of the S&P?
Sure. Here's the S&P weekly.
And why don't you go back to 2008?
Sure.
And what I'm confused about is, to me, this is just a big monster uptrend. And I'm perplexed as to why the technicians are all trying to pick tops. And maybe I don't understand things. Maybe I'm not sufficiently kind of versed in the dark art. But to me, I kind of I look at Richard Dennis, and he was a big kind of trend follower. And I just think that it's a trend that's up, and until it tells you otherwise, it's continuing up. And the reason I bring this up is you had a comment. We were kind of going back and forth, and you said something about the fact that we're in a bear market. And I know it was a little facetious. I get it. I understand that it wasn't truly it's not like you believe we're in a bear market. But Jeff Gunlack says it in a serious, he.
No, actually, I do believe we're in a bear market.
Okay, well, there you go. So what I want to know is, I look at this and I go, it's an uptrend. It's barely ever been below the 200-day moving average. Why do you think we're in a bear market? And teach me.
All right. Well, first of all, let's break this down into two key components. First of all, my conclusion that we're in a bear market is actually not technically driven; it's macro driven.
Bingo.
And the technical analysis is an important bridge in the process of understanding. So I go with the idea, and I kind of approach the markets, and I basically say, look, the market is not made up of stocks. The market is made up of traders and investors and money managers making decisions about stocks. There's a behavioral element. You accept this in sentiment, and just the stuff we just had with Adam and COT reports and all of these different things. It's the study of how everyone is positioned.
Right.
Technical analysis is simply conveying price, time, and volume of how all traders and investors are actively real-time making decisions by voting with their money. It is a chart of the way that everyone's making decisions. And it's the art of tape reading, of understanding where the money flow is going and how it's manifesting on the charts to read those tea leaves, right? And so for me, even though we have certainly made three sequential highs, to me this still has all of the making of a topping formation. Largely, I do have a very large macro bias. I'll reverse this on you. All right, I'll reverse this on you for just a moment. So I'm going to pull up right here Ray Dalio. Can we agree that Ray Dalio is not a technical analyst?
Yeah.
Okay.
I'll agree
So
with that.
so here is Ray Dalio's book on debt crisis, right? Page
Hey,
22.
One second. You already had this ready, Patrick.
I
You
did.
Obviously,
because
you obviously-
because I knew you were going to ask me about market tops. So I want to read you one part here of this book from Ray Dalio. Right? It says early on at the top. So in page 21, he talks about the topping process in a market, right? So this is part 3. And in here, it says early on in the top, parts of the credit system suffer, but others remain robust. So it isn't clear that the economy is weakening. So while the central bank is still raising interest rates and tightening credit, the seeds of the recession are being sown. And now this is the key. The fastest rate of tightening typically comes about 5 months prior to the top of the stock market.
Okay.
So when in this current cycle, in the monetary cycle, when was the fastest rate of tightening?
Well,
Let me just pull up the Fed funds rate. Here's the Fed funds rate. Just so that you can actually have a reference point. When was the fastest rate of Fed tightening?
Well, the Fed has been going every second month for a while, but I would agree with you
Right here.
that when he did his it's a long way from neutral, the market tightened for him on a more accelerated basis. I will give you that.
Okay, so now then I ask you, when was the last Fed rate hike?
It's been a while.
Yeah,
You know
December, January.
better than me. Yeah, okay.
December, January. And so I can't remember whether it was December or January. I'm in the same boat as you. But so the question I have for you, what's 5 months after that?
So, yeah, I understand that.
So the point I'm making is that there's a macro reason why I believe that we're already in the topping formation process.
Okay.
But in my mind, when I go back to the chart, I prefer candles. I'm just going to throw up candles here. But in my mind, when we're looking at this, this entire process has been an extended topping formation in the markets. And so to me, one second here. So to me, this is just the process of the market retesting those highs. And now, by no means has the sell-off we've seen, this is a weekly chart, by no means has the sell-off of the last 3 weeks sufficient data to already suggest that the bear market to the downside has grabbed hold and there's no turning back. I by no means want to conclude that. But this certainly is rejecting along its previous highs, and it'll be very interesting to see what develops here in the coming weeks.
Okay, so I guess that's where I was going because I'm being confused. I look at it from a technical basis, and I just go, why are all these technicians bearish? And you basically argued a fundamental reason why you think the
But
market
but
should go
that's
down?
just the way I approach the markets.
Okay,
There are the Elliott waves guys and all of these other ones that are measuring waves, and they have their own ways of drawing when they believe a market will come to its conclusion, right? But
I guess what I'm confused about is I understand why after the the late 2018 break, people got bearish. I get it. It looked like that was the top was in. And then when we rallied, it was easy to say this is just a correction in that kind of correction, and that we're gonna get the downtrend will resume. My question is, at what point do the technicians finally say, okay, we're wrong, it's time to get long? Because
I'll tell
from a
you, because I'll openly admit that I was dead wrong in 2016. I was one of those people that, very similar to what we are witnessing today, viewed the 2015 into the 2016 period as a potential major topping formation.
Okay.
And I was wrong, right? And what is interesting is that these, if the technicians are wrong, and this is still mid-cycle, and there's another leg to the bull coming, then we are here or here, right? Which is that we've rallied back to retest those previous highs, like we did off of the 2016 low. That there was the Jamie Dimon bottom at the bottom there, and then it was rolling over, and then it just blasted off. And at that moment, there was no evidence. Obviously, that was a big reflation impulse on the macro side, and the central banks were pumping credit in, and that way we went through another stage of the cycle. And this is exactly what it will look like if you are proven right, which is that it will be a consolidation, and that consolidation will prove with a bullish breakout to the upside, and another leg will start. And that's and so if I was to draw on what it would look like if you were right, then we might consolidate, and then from there we would at some stage begin the next phase of a run.
I guess I was just confused, Patrick, because to me it feels like everyone is bearish. There are no technicians out there, or fundamental people for that matter, that are saying that we're headed higher. And I was just looking at it and thinking to myself, I know squat about technical analysis, but we're kind of, if you're like, at its heart, I believe technical analysis is trend following. It's saying the market knows more than any kind of fundamental analysis.
I would trend following, yes, but it is the price is a manifestation of investor sentiment to one degree or another, and how people are positioning. If there's more buyers than sellers, the price must go higher. It's like I know it sounds cheesy, but it really is the way. And so the price, and technicians are observing how people are voting with their money, right? Like
but the reality is that we're pushing up against, we're only how many handles from a new high?
Right.
100? Like 130? Yeah. Yet every technician I know is super bearish.
Yeah.
And that is the part that I'm having trouble kind of reconciling. I don't understand why technicians are telling me that it has to go down, and it feels to me like too many technicians are doing what you're doing. They're putting their macro views on their technical
of course, but you know what, the one flaw of technical analysis, which is, I openly think, I'm a CMT, I follow a lot of technicians out there, and the one thing that is a flaw of technical analysis is that you look at a chart and you see sort of what you want to see. If you want to be bullish, I can find you a reason why this is going higher, and if I'm bearish, I'll find you a reason why on this chart it's going lower. And that's where the unfortunate part is, that a lot of people don't have that objective way of approaching it. They tend to kind of put their biases onto those charts.
It's like that picture of the old lady or the young woman.
Yes.
Right? The thing is,
exactly.
you always see the old lady.
Oh, of course I do. I won't lie. I won't lie that me and the bear have been friends for a long time, and it's hard for me to look at that glass as half full. I won't lie.
You're a Kodiak Grizzly of Bears. Okay.
I try so hard. I try so hard to find that little bull in me. And maybe one day it will come out.
When stocks are higher. Anyways, let's move on to the next thing.
All right. So, Tales from the Trading Desk, Kev. What do you have in store for us this week?
This week, I actually we were talking about different things that we might do, and I thought it would be a great opportunity to highlight a website that I just love, which is Occupy a Job on Wall Street. Like, Patrick, have you ever heard of this website?
No, I have not.
I don't know who it is, but he's hilarious, and he's a hedge fund trader that writes stuff, and he's got 30-odd different stories. Let's call them. Most of them are not safe for work. Actually, they're not even safe for the Huddle. Like I was going through these, and I was like, and that's seen a lot when they're not Huddle safe. Like, you know what I mean? Like that's a lot.
Because we've
yeah, and
we go pretty far.
That's right, and he does a terrific job. And what I'm going to do is I'm going to actually read one of them because I thought it deserves reading. He, whoever he is, because I think he's anonymous, he actually produces a podcast. So if you want to hear him read by somebody a lot better than me, you can go ahead and listen to his podcast. But in the meantime, I kind of shortened one up and I did it, and I think it's just for good taste. We're going to do this Tales from the Trading Desk, episode number 7, Up to My Ass in Alligators. Okay? And this podcast is going to fly a little close to the sun by talking about what the Securities and Exchange Commission was doing during the financial crisis. For the uninitiated, think about the SEC as the policeman of Wall Street. In doing so, we're going to skip ahead to the aftermath back in 2010. The SEC have fucked up by allowing the financial crisis in the first place, and they are angry. What is the SEC doing? In 2010, the SEC are trying to figure out how the most notorious hedge fund in the world, known as SAC, made $276 million in profit on a single trade while the rest of the world was losing their shirts. This is the scene. One of the most powerful sales traders on Wall Street, let's call him Don, has been called into a meeting with no less than 5 SEC lawyers. Don is sitting down staring at one of his shoes, frowning. Don's lawyer is sitting next to him, also staring at Don's shoes. Across from them are 4 men and a young woman in gray suits looking serious. They're sitting down with their briefcases in front of them. Don and his lawyer look up. Don is smiling and his lawyer is frowning. SEC agent number 1 starts off. So how do you know SAC? Well, Don says no one knows them very well. Well, SEC agent says, well, we have over 1,400 instant message conversations between you and a trader named Tim. So you seem to know them better than, say, an average man on the street, correct? Isn't that what you call yourself, the street? Don's lawyer interjects here and tries to call an end to the interview. The reason Don's lawyer is scared is because no one back then that knew that AOL instant messages didn't just evaporate after you close down the program. It sounds ridiculous now, I know, but it just didn't occur to us. It shows you how stupid New York congressmen are in 2018 that they're still sending insider trading emails on the White House lawn, no less, and getting caught thinking that they're not discoverable. And that's email. AOL IM seemed infinitely more ephemeral back then. But they weren't. Instant messages were just as discoverable as email. And this is where Don finds himself. The SEC agent continues. Why don't we start all over again? Show a little good faith, okay? How well do you know SAC? Don says, I know a guy there named Tim. SEC agent says patriotically. I can't even say that. That's too many beers. That's better. Would you say he's a friend of yours? Don says, I've got 3 friends on the street. None of them work for SAC. Let's get to the point, shall we? Don's lawyer looks petrified just now because there's been no discovery, and this is where the rubber meets the road. The SEC lawyer turns to let's try that again. The SEC turns to the lawyer and says, we reviewed the 3 years of Don's AOL instant messages, and your colleague has been talking in some sort of code to SAC. Perhaps you could tell us what some of the codes mean, sir. They don't appear to be stock symbols. In at least 30 conversations in 2008, you used the letters. Okay, now, Patrick, this is where it gets funny. In at least 30 conversations in 2008, you used the letters LMA. I count 106 uses of GFY and 120 uses of SMT, and finally 50 uses of TTFN. Don just starts laughing. It's pretty clear to me that you guys are just traffic cops getting paid to punch tickets and justify your budget. Well, LMA stands for lick my ass. Why don't you figure out what the other 3 codes are, stupid? Listen, this Occupy Wall Street guy, I'm telling you, that is the tamest of his stories. They're outstanding. They're just outstanding. Go look at episode number 37, The Intern. I was just kind of like, I was busting a gut.
We got to
laughing.
share a few more of these in the coming weeks because these sound pretty good.
Well, I don't know if we're going to be able to share any because they're so not safe for work. I'm telling you that they're just
so.
Can't
We just like do the beeping? Like we can have Lena come in with a beep beep.
No, listen. Someday my wife's going to figure out that I do this podcast for a living, and then she's going to go listen to these, and she's going to be like, "I can't believe you read this shit. This guy's terrible. He is like everything that is awful about Wall Street. This guy did." Anyways, it's outstanding, funny stuff. Make sure you go read them, listen to them, whatever. Occupy a Job on Wall Street. It's worth your time. It's fun, and make sure you give them a listen.
All right. Well, thanks for sharing, Kev. All right, it's time to move on. Kev, it's time for This Week in Trading History.
Your favorite time, Patrick?
Oh, it is, and.
It's like, you got a business degree or whatever, but you really should have got a history degree.
Oh, come on. That's too much work. It's too much work.
As opposed to the business degree, which is really easy.
That was easy. Come on. It's just about looking at little squiggles going up and down, right?
That's right. Okay,
anyway,
what do you got in
This Week in Trading History. Okay, so I want to go back to May 21st of 1720, basically 300 years ago, back to England for the South Sea Bubble. And so on this day of May 21st of 1720 in the newspaper, the Daily Post, was featured an ad for initial public offering during the South Sea Bubble that was basically it was a hot period. Basically, think of the .coms or like the ICO craze during the cryptos, where a lot of these bubble stocks were super hot because one stock was running super hot and making a pile of money. And so the point is that a lot of these questionable companies came onto the market, and so there was about 190 companies during that period that were issued into the mania, but no one exemplified the craze better than this company, which was featured in that ad, which was offering a proposal to raise a sum of like 6 million sterling, which back in 1720 would be like hundreds of millions of dollars. And the best part is, the best part of this is that the company advertised itself in the newspaper as a company for carrying out an undertaking of great advantage, but nobody to know what it is.
Nice. It was like a SPAC, special purpose acquisition vehicle.
Yeah,
like it was a SPAC.
We promise you we're going to raise money for undertaking that will be of great advantage to you, but we can't tell you what it is. But so I wanted to circle back to the South Sea Bubble and really just go through a little history lesson of it. And it goes back to 10 years earlier to 1710, when Robert Harley, which was the Chancellor of the Exchequer in London and in England, and the government at that time was running out of money. He gets this job, and the government is pretty much insolvent, and so they're trying to figure out how to deal with all this debt. They're pretty much at war with everybody, and the government was divided. They couldn't get any legislation through to raise taxes. He couldn't turn to the Bank of England. By the way, back then the Bank of England existed. It was one of the first central banks in the world, pioneering central banking. And shockingly, you can't connect the Rothschilds to this because Mayer Rothschild wasn't even born at this time. It was actually
The Colonel with his little beady eyes.
Yeah, there you go. But it was before the Rothschilds, even when central banking was being pioneered in London, England. But anyway, so he couldn't turn because the opposition party controlled the Bank of England because all their buddies were in there, and they couldn't go outside to global creditors because that wasn't an option because at the time England was pretty much at war with everybody, and so he had to figure out how to deal with this debt. So he turned to one of his buddies, this John Blunt guy who ran this company, his Hollow Sword Blade Company or something. And they came up with a scheme. And to make a long story short, because this could be a 30-minute segment if we made the long version, but the scheme was the idea of refinancing the government debt by creating the South Sea Trading Company. And we'll talk about where the inspiration came, because it came from John Law and the Mississippi Company down in France, which was running about the same time. And so it was inspired by the South Sea Trading Company, which the government was going to give an exclusive charter to trade with the Americas, primarily the South American ports. And the funny part of it is that, of course, the company was never able to make any revenue or even turn a profit or anything in the endeavors. But that's actually not the cool part of the story. So what the scheme was essentially they would make a lucrative offer to the bondholders of the government debt to trade in their government debt in return for the shares, like a swap.
A debt for equity swap.
A debt for equity swap, right?
Nice.
And so they make this company, and they legitimize this. They legitimize this because eventually they put King George I as the governor of the company.
Oh.
So you have the actual.
Wait, is he the guy who killed all his wives?
Oh, I don't know. I don't think so.
I know we're not English, like we don't know these things.
But I mean that's a legitimate thing. You've got the king himself, actually the head of this South Sea Company, right? And this John Blunt made sufficiently large enough. Got a sufficient amount of the politicians on board with bribes with these lucrative share deals where he had no problem getting this passed through the government. The deal basically had all these MPs being able to buy stock of the company but not have to pay for it until they sold. So basically, they were getting free access to the company, and this was great for John because he basically had to pay no cash for the bribes, but gave huge incentives for the politicians to keep seeing the stock rise.
Right.
Right. So you see where this is going. We're taking the entire national debt of England and converting it to equity.
Nice.
Right. That's
nice.
the starting point. That's the starting point of this
Right.
bubble. So now the government would allow the South Sea Trading Company to issue an amount of stock equal to its debt. But the catch was that it was calculated on whatever the share price was at the time the law was passed. But the moment that this started happening, the stock started to rise, and this gave the opportunity for them to exchange fewer and fewer of the shares for all these bonds, leaving huge amounts of the shares for profit in the company for Blunt and his buddies and the company revenues. And so the company never got going successfully as an actual profit and revenue generating enterprise. The only source of revenue for the company was the share price rising, which they had all the excess shares of.
Nice. That's always a great. That's always a great
A
source
great
of
business
revenue,
model.
Though, right?
So,
Yeah.
so like a proper Ponzi scheme, the entire plan hinged on the stock continuously rising. So each time the stock started to dip, Blunt needed to come up with a new way to prop the stock higher. And so one of his mechanisms that he came up with, he devised a financing plan to buy the shares directly, to let individuals buy the shares directly from the company with a 20% down payment and not have to come up with any further payments for 2 months. And they can start making installments at that point. And so
nice.
think of it.
I didn't realize that. So he was the first kind of innovator of the receipt trade.
Right. Right,
Yeah.
and so what happened here was that it's like the modern day kind of real estate flipping. Like in Canada, what during the real estate craze, everyone would go and put a $20,000-$30,000 down payment on a new home that doesn't close for a year, in the hope that the real estate market rises over the next year, so they can flip it before they actually have to really buy it.
Well,
Right,
of course, because don't you know Canadian real estate always goes up, Patrick?
it always goes up. That's a
Yeah.
safe trade. Now, so this allowed huge leveraging up. There were these people that were essentially leveraging up 5 times the amount and flipping it basically 2 months later, never having to come up with the money to actually buy the share or make any installments. And
It sounds exactly like Toronto real estate.
It does, doesn't it? and we got to include Sydney in that. Sydney real
correct.
estate as
Yeah,
well. And nonetheless, several months later, the price started to dip again. So he came up with an even new plan. And so he started to actually issue the South Sea company itself. So from all this money that they were collecting from doing this, they were offering loans of up to £3,000 to people to buy their own shares. So, so they were basically. So this was today's version of share buybacks, but they were having the public do it. Now today, companies are far more refined and more kosher, and they do this financial engineering by just buying their own stock back with their own money.
And nowadays, people are much more sophisticated. They get on Twitter and talk about $420 buyouts.
So now, Kev, of course, when you have this much froth about one company making this much money, rising, and all of this, this led to the first IPO craze of our time. And so what happened was that because the appetite for easy money and all these profit-hungry investors were there, of course, everybody comes rushing out to want to take a company public, to take advantage of all of these speculators that are frothed up. It reminds me so much of the ICO craze that happened last year, right? And so you have a scenario where about 190 of these companies came out and issued these IPOs. And one of them, of course, was the company we referenced at the start of the session. But what's amazing is literally only like a year later, like only 4 of the 190 companies that went public were still around. The rest all basically were either fraudulent ventures or were just vaporized in the bubble burst afterwards. Isn't that crazy?
It sounds just like the ICO craze.
Oh, and the .com craze too, right? Like the pets.com, and like it's amazing how this shit repeats itself over and over again, right?
Yeah, it's
and
funny.
So,
like that's the 1700s. Like that's it's like 300 plus years ago that this happened.
Yeah, no, it's crazy. And so, like all bubbles, the Ponzi and Ponzi schemes, for that fact, like, so if we're talking Bernie Madoff or anything, it becomes a victim of its own success, which is that when the size grows so big, it simply collapses under its own weight, right? Like there's a point where it can't sustain itself anymore. So I thought it was really interesting to kind of think about the size of it. Now, when I showed this chart last week when we talked about Standard Oil, but South Sea Company makes it as the 3rd largest company from a bubble perspective. It was about on an inflation-adjusted $4.3 trillion at the time. But what was amazing about it is actually putting the size of the company relative to the size of the British economy. So what you want to think is that the company was at some point worth, from a capitalization. So remember, there was about like 30 million pounds of government debt that was converted into equity. And that increased tenfold. So the market capitalization of this company was like 300 million pounds. But if you translated it to the size of the British economy, it would be the equivalent in the U.S. today of having a company that had a market capitalization of $85 trillion.
85 trillion?
Yes. Like,
Now that's funny.
So what you want to think is that genuinely and rightfully so, Blunt was concerned that there was not enough money in the country to support the stock price.
That's always a problem when
That's always a problem, right? And so this thing is this gargantuan beast, right? It's just it literally is the entire British. Imagine Trump saying our solution is to take the $20 trillion of federal debt and we'll just turn it into equity. We'll give it some nice spin and we'll
make a Trump ICO. That's what he should do, man.
Yeah, just convert all the
a Trump ICO on the blockchain because that's great shit. Like that blockchain stuff is awesome.
This is crazy. So anyway, the crazy part is the company never made a cent selling goods from the South Sea. It burned through almost all of its cash. And at the end, what was crazy was it was the proverbial smart money, dumb money pivot, which is that right at the top, they did an offering at £1,000 a share. And they made an offer to the public that you only had to put 10% down with no payments for a year. Okay. It's like a ninja loan. It's like a ninja loan, dude.
No, it's like a receipt, like unbelievable receipt, like it's crazy. And but like the thing is, it wasn't an option. You had to put the 10%. You had to pay the rest 90% in a year's time.
So on the chart we're showing here on the thing, you can see that chart on the middle there where it went parabolic. It literally hit 1,000. That literally marked the top of the stock rise, and rightfully so. Just the way you've shared many times on the show, like sometimes at the end of a bubble, the greatest parabolic rise is right at the end, and so it rose from like 100 to like 500 in a span of like a year, and then it was just in weeks that it went from 500 to 1,000, right?
Wow.
Like there was that
unbelievable.
parabolic.
That's a great chart, man.
It's crazy.
Yeah.
And but what's amazing is that because the smart money knew how crazy this was, a lot of the really people that got in early started dumping the stock into that offering, and then he tried to prop it up again by offering it. Get this, he made a desperate attempt to prop up the stock by announcing a 30% dividend a year.
and a shit show, man. Like it's just unbelievable.
And if there's any way that you can for certain make everyone know that it's a Ponzi scheme, is to realize the capitalization of the company and saying, where the hell are they going to come up with 30%?
Hey, listen, I
cash
just realized as you told this terrific story, I realized that Elon's got an answer to his problems.
What is that?
A 30% dividend.
He should, yeah, for sure. Tesla should announce a 30% dividend.
Or better, you know what? What about 10% down on a stock purchase?
Yeah.
That's awesome. You know what I like best about this chart is the fact that it never ticked at $1,000.
Actually, I think it did because
it doesn't look like it.
It doesn't look on the chart, but it was offered at that, so there were definitely people buying it on that.
Yeah, but don't
offering.
forget the people were buying it, but they only had to put down 10%. Yeah. So I'm betting that that's right, and it never ticked at $1,000, Patrick.
Maybe
because those people would buy it.
You know, I even though you're old, I know you weren't around back then.
Yeah, that's even a little old for me. You know what? Yoda was around, but I wasn't. But that is a terrific story. Now,
okay,
listen,
wait. There's one last
sorry.
thing. Okay, no. Go on. You have a quick point.
I have a quick point. I see this great historic heavyweights chart. So far, we've got the Dutch East India Company. Now we have South Street.
South Street.
South Street. That's a burger place in Toronto, for those who don't know. You know what? We taped this on Friday night before dinner, and I'm hungry. But I see that there's now Mississippi and then Mississippi Company, which I'm looking forward to. And it's unfortunate we couldn't do that one today.
That's John Law. We're going to still do that one.
Yeah. But then what's amazing is Saudi Aramco's up there.
Yeah.
I had no idea it was that big.
Yeah.
Did you?
That was in 2010, though. That was.
I know, but did you know it was that big? Like
I heard it was $2 trillion, at its recently, not 4. I mean, but that was a decade ago, so I don't know what the circumstances were for it being that big. But that's got to be a story we talk about at some point.
For sure,
right?
that's going to go into the market history segment.
So I need to leave it at this: Sir Isaac Newton, Newton's law, the great physicist and mathematician, got caught up in the South Sea bubble.
Really?
And so, yes, he did.
I didn't
and
know
so, he was coined for saying that he could not calculate the madness of people.
Oh, that's right. I know this story. He says I can figure out the trajectory of
movement of stars, but I
that's
can't. But not the madness of men.
Yeah.
And so he lost 22,000 pounds,
which was back when
in
22,000 pounds was a lot, and not just a.
Yeah, no. That was the equivalent of like $3 million today, or some crazy amount.
Really?
And so, absolutely, it was crazy. And so, but what was the best was that he first got in the early stage and flipped it for 100% return, making like 7,000 pounds. And so he made himself a millionaire at the time. And then the temptation swept him up, and the enthusiasm to go back in. It's the famous chase scenario. And so he goes. It's like you having bought Bitcoin at like 100 and then
I never
no. You never got back
in. I mined Bitcoin at 100. But there's lots of Bitcoin fans. There's lots of Bitcoin fans that you're right. Made all sorts of money on the way up and now are getting schmucked buying it again.
But they bought, then they sold, then they realized it was kept going higher, and then bought back in at an even higher price, and then got smoked. What happened.
Right.
That's what happened to. That's the story I was trying to imply. Not that happened to you with Bitcoin, but I was just trying to create a story to relate to. But basically, one of the smartest men to ever fucking live, basically was pretty much bankrupted by the South Sea bubble, and for the rest of his life, he forbade anyone to speak the word South Sea in his presence.
Nice. That's going to be like me with JGB and Boons.
Never shall we speak of them in your presence again.
Anyways, Patrick, that was a terrific story. Thank you so much, buddy. That was awesome.
Kev, time for your famous WTF clips of the week. What do you have in store for us this week?
Well, it's a good one, and it's a quick one. It was actually one of my favorites because it was so easy to make, but it was so good. And I don't know if you're aware, Patrick, but there's a lot of people speculating on LA real estate. And when these guys speculate, they're in another league. It's not just kind of buying a Toronto house and flipping it for, paying $3 or $4 million and putting another $1 million into it and selling it for an extra $1 million. These guys, like all Americans, they play in the big leagues. And I saw this guy who's a plastic surgeon, and he had, he had gone, let's just say, all in. So let's have a look. Let's play the video, and then we'll talk about it.
All right.
As the plastic surgeon to the stars, Dr. Raj Kanodia has worked on everyone from Kim Kardashian to Jennifer Aniston. But his latest project, a 34,000 square foot mansion in Bel Air, has an uncertain future.
That puts me all in. So what? This guy's bluffing, I know.
Kanodia built the home in hopes of flipping it for a big profit.
He's got me beat. He doesn't have you beat. Come on, it's all or nothing. Come on.
But as it grew in size and cost, Kanodia struggled to find lenders and investors.
I don't know, man. Come on, don't be such a wuss. Just call him. Come on, Joe.
His real estate friends told him he had made a big mistake.
You're sure he's bluffing?
Come on, don't be such a Sally.
They said, you're way out of your league.
It was finished. Kanodia listed it for $180 million. But like many high-end communities today, Bel Air has an oversupply of mansions.
Come on, all in. All right. I'm all in. Good.
In Las Vegas term, it's called all in. Like all in times mid.
I'm all in. Nice. Oh, so he wasn't bluffing. It's crazy.
Wow. That's crazy, Kev.
It's nuts, eh? Like, I just couldn't believe it, and I was laughing so hard when he said I was all in, and I thought to myself, that reminded me so much of that poker video that commercial where he says, "Don't be such a Sally." That's
Don't
like
be
our
such a
favorite-
Sally.
That's like our favorite line when someone at the trading desk was being, like not was kind of, let's just say not owning up or not being like willing to take the trade really quickly. We'd be like, "Don't be such a Sally, just do the trade," and I just love it. And that guy, he wasn't such a Sally. Like he just went for it and like balls to the wall. That guy's crazy. Like think about those numbers. Like those are crazy numbers, and like that
$180
$180
million.
Yeah, and you know what's amazing is there's like 10 houses for sale in LA in that kind of price range. Like that's like Canada's GDP. Like it's just nuts, man. Like that's just a dumb number, man. Like, and I just thought this guy, like some plastic surgeon, deciding, okay, you know what? I'm going to build myself a $180 million place.
But I got the impression he was buying it to flip. Like, why would you build a place like that if you can't live in it, right?
Yeah, no, for sure he was building it to flip because it's such a great investment. And then the part that I loved best was that he was having trouble securing financing, and he was having some difficulty convincing people to invest in his house. And I was like, dude, you just built a $150 million house that you're trying to squeeze out. That guy is going to get tagged. That's all I can say. Like, there's just no way that's going to work.
He's going to be a plastic surgeon for many years to come to make back that gap.
That's true. He's going to have a lot of facelifts to do to pay for that error. That's all I can say. Anyways, let's move on.
All right. So, Kev, let's go to the top 5 things to watch next week. But before we do, as always, we review what we were watching last week. So let's go through it, starting with number 5. And so last week, oh, no, it was a holiday. Yeah, we were joking. That's a joke. Never mind. Number 4, Royal Bank earnings. And, well, whether or not people were happy with it, the stock certainly did not respond well to the initial earnings report. So here I have the chart on Royal Bank, and you can see here that the first reaction on the earnings was a dip, right? I know.
Right. Yeah, and CIBC shit the bed. Listen, Canada is finally having some trouble with the real estate. The hedge funds have been calling it for the last 5 years. They're finally going to be right. Our good buddy Jared Dillion's going to finally get his call. He's been waiting for, he's been bearish the whole way up, and it's finally coming. So I think he should have a big smile on his face because I really believe that the next move on the Canadian banks is probably lower. It's difficult.
You and Steve Eisman.
Yeah, listen, and I like Steve Eisman because he's not sitting there telling you that it's the big short again. He's the first one to say, listen, these things are headed lower, that they're going to have some trouble, they're going to struggle, and I agree with him. Do I think that it's going to be another Citibank where they're on the brink of insolvency? Not a chance. I don't think that in the least. But do I think these stocks are good investment? No, I think they're going to have some trouble in the coming months. Canada is like, listen, Australia is having even more trouble. Australia is really struggling, and Canada is just a little Australia without all Australia was Canada on steroids. That's how I look at it, and we're gonna struggle. That's what I think.
Yeah. So number 3, Kev, European PMIs. They came in relatively weak. I know France. Here, I just have quickly on the screen right over here, and so the German, the French flash services PMI and manufacturing PMI came out stronger. I don't know what the French what magic juice they're drinking, but they're doing just fine. But you have the Germans more or less missing, and the broader European flash manufacturing PMIs and service PMIs all coming below, right?
Yeah, and that's the big one. The European, across the board, Europe is having trouble. Yeah. There still shows no signs of kind of bottoming yet. I still contend until they allow their governments to run deficits, we're just stupid. It's just dumb. And, everyone's heard me. I'm a broken record, so I don't need to say it again. But extreme monetary stimulus with fiscal austerity doesn't work. And the Europeans are going to show us how that doesn't work over and over again.
All right. Number 2, breakout or fake out for the U.S. dollar and bonds. And it's actually 2 stories, right? Because the dollar literally looked like it was about to go for a run. And and then on the dime, just a prairie dogged temporarily to a higher high, and then just gave it all back.
I saw one of our listeners talking about a pump and dump, and I was like, he's got the wrong technical formation. That is not a pump and dump. That is a prairie dog.
That is a prairie dog.
A noble animal. A noble animal.
And not what Lena says.
Yeah, that's right. Lena is forever ruined prairie dog in my mind. But no, as a Winnipegger, it is a noble animal. Now, everyone's getting all excited because the technicians saw a new high that wasn't followed through with confirmation. And I call just bullshit on that. Let's look at the trend line. The trend line is it's a series of higher highs and means higher lows. And I'm not that excited about it in terms of the fact that we didn't explode higher. I still think, and I'm going to stick to this, I said it before, Patrick, I didn't say that we needed to wait for a breakout to buy. I said we should just buy it. You should be long the U.S. dollar. I still contend that's the case. We're headed higher. It's going to chug higher. There's going to be no magical technical formation that allows you to buy it and it's going to take off. It's just going to chug higher.
Sure. You know what, though? The dollar index, though, is really driven by that euro. The euro tried to poke to a lower low, didn't do so, but we'll see how that develops. But I wanted to just touch on those bonds because when I pull up here the 10-year Treasury, where do I have it here on the future side, it did break to a higher high, right? And I'm enjoying this a little bit.
Yeah, a little bit, more than a little bit. You guys are right, no doubt about it. The sentiment is as bullish as I've ever seen lately. I wrote a piece about it today. For those who don't want to know, it's called The Hardest Post. And you know what? Hats off to you guys. It's headed higher, but I'm scared about it. And I saw the J.P. Morgan kind of bond sentiment index is as high as it's ever been since the Great Financial Crisis.
Listen, where I'll agree with you on one thing is that I do not believe that this is just going to be a straight line higher. And there is almost certainly going to be, I still think we could go to the 126 handle, 127, but on the bond to the upside, which if we can translate to yields, which is what a lot of our listeners watch. Let me just put the yield up over here. But the one thing I would say here, actually, here we go. There. So that would equate to somewhere around 2.25. Let's say we could probably see 220, 2.25. But with that said, there's going to be a period where everyone that's chasing this trade is going to get washed out. There's going to be some. While it doesn't change my bigger view, and me and you are going to have this bull bear debate for many months and years to come, but I do believe that this is not an easy trade here. Yeah, if those people that are getting into this trade right now, there's no asymmetry in this whatsoever.
Okay, well there you go.
So
you know what? You got problems when Patrick's not agreeing with your long bond position right here. So be wary of those guys that are chasing it up here.
Well, you know what? I'm still bullish. Don't misinterpret.
No, I get it. I understand what you're saying.
It's not a trade to chase at this moment. So let's start number one. FOMC minutes. They certainly walked away from their overly dovish stance. It was a little more on the hawkish side, wasn't it?
You know what? You guys say it's a little more on the hawkish side. What are you guys expecting? Jesus Christ. You're expecting them to turn around and start cutting rates tomorrow. It wasn't that hawkish. It's just that the market has gotten so far ahead in terms of expecting the FOMC to kind of chase the economy on every blip, and so I don't think it was that.
I personally think that they could not have possibly said anything dovish. Otherwise, they would have fueled a potential bubble breakout on the upside of the stock market, as this thing would have. If they started talking outright dovish, I think the stock market would have responded incredibly well to that. And I don't think the Fed wants that either. And so I think this is exactly what we're getting is what we'll get a lot more of in the coming months, which is they're just going to pause. Maybe they'll come in if the stock market takes a massive dump on the downside, then maybe they'll come in to kind of try to talk it off of the downtrend. But I think if the market's up here, the Fed is going to be pretty silent and not going to change their language very much. Do you agree with that?
I don't know. I'm not sure. But anyways, I'll let you have the last word, Patrick.
All right. So let's move on to the top 5 things to watch next week. And so let's get to number 5. And this is where I want to talk about the defensives versus the cyclicals. And, whether you go to the hedge eye guys with their quad 3, quad 4 scenarios, but it's actually pretty basic macro stuff in terms of where you want to be in terms of duration and whether you want the growth high beta versus the defensive bond proxy kind of stocks.
Whoa, Patrick.
Yeah.
I think I'm going to tell Keith you just called this stuff very basic.
I did not say that. Oh my God! No, just kidding. But I
you don't want to be on Keith's bad side, man.
No, I
the
do
guy,
not. Don't say it. Don't tell him. No. But the point is that the defensive have been doing incredibly well. So look at this is the consumer staples, and obviously Procter and Gamble leading the way in this, but the consumer staples have been holding up just great. The utilities continue to be in great shape, making fresh new highs.
That chart looks unbelievable. Even all you technicians have to be chasing that. It looks. All the defensive names are getting just chased like unbelievable.
Absolutely. Look at that fresh new high on the REITs.
Yeah,
right?
It's just
it's
unbelievable because that is what's pushing the stock market higher. Or not higher, but it's interesting that that's what people are pushing themselves into. That is what they're chasing at this point.
Yeah, but don't you think that when you're looking at the bond market, that is just a manifestation of the fact that that this is just one big asset rotation? Is that, and also would that not be what you would typically expect to see at a topping formation of a stock market?
Listen, you had me until that last bit, Patrick. I just think that we're going to get a rotation back into real stocks again, and not this kind of scared feeling of you got to buy utilities and staples. And I think that those things are interesting things to watch because I think those will be the sign that when they start underperforming, that you should go out and buy the broad market again.
So what I will agree with you is on this. Which I don't know. Actually, I won't speak for you. You can tell me whether you agree or not. But while I remain bearish, while I believe yields will eventually go lower, at some point in this calendar year, in the remaining 6 months, we will have a multi-month mean reversion on all of this. And the yields and the defensives are all going to mean revert this big move that we've seen. And maybe during that period, the cyclicals will get an uptick. But I just don't envision that this is just an easy trade to keep chasing this. At some point, the people that are chasing this are going to get washed out.
Well, it's nice to see us agree on something, Patrick.
Okay.
Let's go to number 4.
So that means we should go. Everyone of our listeners should go along these defenses.
That's right, because
we
we're
agree.
going to continue to go. Yeah.
Oil.
Breakdown in oil.
What the hell?
So Patrick, you must be happy. I was laughing when you told me that when I saw oil was going down, you had a big smile on your face because you're bearish. I think you told me that you were bearish oil, and I was like, "What aren't you bearish on?" It was like,
I'm not bearish on bonds.
Exactly. That's what you responded. You said, I'm not bullish. I'm not bearish on bonds. Everything else I'm bearish on. You know what? I just think, what do you think? Tell me what you're thinking on oil.
Well, I think we're at an incredibly important technical level, right? A very common technical pattern is and it's also an Elliott wave and so on, is the zigzag kind of correction lower. And arguably no different than the stock market today. You could argue that this is just a consolidation of an uptrend. And one of the, in my mind, this kind of 58, 50, $57 area is actually a pretty important support line. I mean, in theory, if the bulls can hold the line in this area in the coming weeks and get the price back up into the 60s, then this might have just been a correction.
Yeah.
But I'll tell
one thing, Patrick, I want to point out is the fact that if you look at Brent, it's a little bit of a different story. And I think we had Chai Girl on, and she was the one who highlighted the fact that the Brent WTI spread, she kind of forecasted that was going to go to widen, and which it is. I think
$10,
this is this is a kind of a USA story, and I still think Brent looks pretty good. And
this chart is the same, Kev. Come on.
No, it's not. It's not the same. And go look at the WTI Brent spread.
The drop in the last, let's say, 5 days was about a $6 drop, about 8.5%.
Holy shit, Patrick! It's gone from 44 to 76, and the thing's moved down $10 from the highs.
Just
you
stop
guys are
for a
all
second.
bearish.
Just stop for a second, and let me make my point. Okay, can you agree that this drop in the last week was about an 8% drop, or about $6, right?
Okay.
So when I go to crude and I look at this drop over here, so it was a $6 drop and 9%. So you're talking about the fact that Brent dropped 1% less than crude, and somehow Brent's holding up better. I call bullshit on that, bud. That's the same shit in a different package. I think that oil got slammed, and it wasn't just a WTI story.
Okay.
Anyway, but the point I'm making is that I too many beers, isn't it? Like at this part of the show, we're well.
It always devolves. It always devolves at this point. Okay, go on. Just make your point. Let's go on to number 3, buddy.
I think that this is a make it or break it moment for oil. This correction can just be a correction. For this to be a shit show, we have to see sustained price action below this kind of 57, 58 level. Then the more ominous kind of downside risks become.
So, Patrick,
prevalent.
you're giving me the typical technician response.
Yes, absolutely.
If it goes lower, I'll sell it. If it goes higher, I buy it. Okay, let's go on to number 3.
Number 3. Next week, in the middle of the week, we have Bank of Canada with their rate statement. Obviously, they're not cutting yet. Everyone's anticipating them to stay at, like, was it 1.75? I think we're at in Canada.
Yeah.
On the rates. But I'm curious how much Polos is going to start to admit that the Canadian economy is looking like shit.
Yeah, I think he's going to be slow to admit that, but I think that he's wrong. I think the Canadian economy is suffering badly. The real estate, which has been a big driver for the longest time, is come
properly
off.
slowed.
Yeah, and it's not the end of the world. It's not kind of 2008 redux, but it is a problem, and we're going to underperform the U.S. and there's nothing more to it. Like,
do you think that this primarily manifests itself in the currency?
Yeah, I think the currency is one of the elements that'll and the trouble is that I'm a little bit of an oil bull, so I kind of struggle with that a little bit. But I do think that it's difficult.
You didn't mention that at number 4.
Yeah, no, I did. Listen, I'm bullish oil. I think that I took this opportunity. Oil vol kind of spiked. I sold puts. I think it's dumb. Like, I think it's nuts. Like, I think we're headed higher, and you guys were all too bearish.
Okay.
I think this is just a slight correction.
All right, so back to number 3. So your conflict between oil and the Canadian economy.
So I just think that as oil goes higher, we're going to be relatively insulated versus like in Australia, but that basically Canada is going to have some trouble with this real estate slowdown that we're going to experience. Like, it's just foolish to think that we're not going to have a like that somehow we've magically repealed the kind of the cycle of real estate, and that there's no way that our real estate will continue going up forever. There's not a chance.
Yeah.
And it's finally here.
Number 2, Kev, is the U.S. GDP. And coming out next week. And one of the things that I'm curious about, look, I think we can both agree that even if there was going to be a recession in the U.S., the likelihood at this stage of a negative GDP print in this calendar year. Is that window is closing pretty quick. But I'm in the Lacey Hunt camp, which is that GDP will continue to be under pressure for the remainder of the year. And I think we're going to gravitate lower, not higher. Where are you standing on this?
Well, Patrick, as usual, you're in the Lacey Hunt camp. You love that guy. I joked on Twitter that you had pictures of Lacey in your bedroom.
Yeah.
I think it's true.
I do.
I really think
my wife keeps taking them down. So
that's right, and she actually phoned me and said, "Could you please, intervene?" It's like that show on A&E about intervention. We have to have one for you. The reality is that GDP is a backward-looking number. So I'm not that excited about when we see this next U.S. one. It's going to be weak. Like we're having a pause. There's no doubt about it. The global economy is having trouble, and the U.S. is finally, Powell pushed and raised rates to a point where it actually caused some problems in the U.S. Do I think this is a big deal? No. Do I think that this is the start of something more ominous? No. But in the meantime, all you guys are hyperventilating about every bad economic number that we see.
All right. Number one, watching China, right? I mean, there's the manufacturing PMI is coming out at 9 p.m. on Thursday next week. I have a chart just showing the last wave of these. Now they're forecasting it to come in at 49.9, which is just under the 50, which is a contraction. But when you look at the chart, I mean, they've already had a sequence where 3 of the last 5 months were already negative. And so we've seen a complete slowdown in China. And it'll be interesting to see whether that was a trough that we saw in the start of 2019, or whether or not we see sustained weakness in the coming months. Any opinion on this?
Well, I don't know, Patrick. I'm assuming you're negative because you're always thinking the world's ending. So, it's not that I think China's going to do so great. They're having trouble. They're struggling more than the U.S. with this trade war, no doubt about it. I'll concede that. But I don't know if they're going to shit the bed, so to speak. I don't know if we're going to have this collapse that everyone's expecting. And that is what I worry about. It's more than the question about whether the Chinese manufacturing ticks down, is whether it ticks down versus expectations. And if you can tell me where expectations are, I think that they're abnormally depressed and that it wouldn't take much for them to beat expectations. But shit, what do I know?
All right. Well, but they are really interesting things to watch next week. So I think Monday is a holiday, so shortened week for all of our American listeners. Enjoy your long weekend. We just had ours this past weekend.
That's right. So Patrick, before we go on, though, I think we're going to do something. You and I are getting together on Monday, right?
Yes.
And
it's time for you to concede.
Yeah, I think it is time for me to concede. I think we had a bet.
Yes, we did have a bet.
What was the bet?
Well, all of our listeners know, our loyal listeners know, but we showed the semiconductor chart. And,
why don't you pull it up?
And we simply we identified what it was just right after. It was
Intel. It was Intel because Intel had happened, and you got super bearish because Intel news was bad.
I was not bearish. Our bet was very simple. Our bet was that I asked the question whether or not semiconductors were their role as the leadership during the bull phase was over, and the simple my view was it was, and your view was that it was still going to be in the top 5 performing sectors, and you were brutally wrong.
Yeah, I have to admit I was wrong. And I guess I owe you a burger. Thank God I only bet a burger.
Monday, because the markets are closed, I'm taking you up on this.
Yeah, I know. Agreed. We're going to go out, and I'm going to buy you, a burger. We're going to go. I'm going to admit that I was completely wrong. Now, having said that, I just want to kind of say why I was wrong. It's no excuse. I was still wrong. But I contend that without the trade war issue, this wouldn't have happened. So in essence, you were betting, and the reason you won this bet
Was Trump.
was because of the trade war. And listen, maybe you were smart enough. Maybe you knew that was going to happen.
I had no idea.
Yeah, whatever. But I think that is why the semiconductors are doing so badly. And good for you, Patrick. It's nice to see you win one.
It's all it's you can say trade war all you want. I think Intel shit to bed long before the trade war was an issue, and I think that this party was over. Maybe under the different circumstances it would not have been as ugly.
Yeah,
but I still
but you were always
I was gonna always win. I was gonna always win.
There you go. So
you know
be it. There we go. The dark arts wins again. Voldemort took over the castle. Okay.
All right. So, parting words of wisdom. I picked this one.
Yes, you did.
Edward,
usually I pick these ones.
Chancellor.
But you actually did this one.
I felt it was appropriate for the South Sea.
Okay, go ahead.
Right. Speculators did not buy bubble company shares as long-term investments. They bought them with the intention of selling them onto greater fools. In a very short time, however, they were to discover that they were no greater fools. So there were no greater fools in the market but themselves.
Oh, Patrick,
and while it applies to the South Sea, I do say that those that are buying the stock market up here, believing it's going to go higher, are only doing so to believe that there's a greater fool up there who believes that the stock market is worth 3,600 and will be on the S&P and will be happy to pay you for this. And at some point, when you're at these CAPE ratios, you're going to find out that there is no greater fool, Kevin.
Yeah. So you know what? It's much better to buy bonds with a negative real yield. That makes a lot more sense. Anyways, Patrick, it's been a lot of fun, buddy. Let's remind everyone where they can kind of tune in and what they should do here. And by the way, what did you think about our splash page today? Do you think that was offensive to Market Huddle fans?
No, I think many of our fans are quite satisfied with this and feel that we've done a great job in including them.
That's right.
Anyways, what we should do is we should take our favorite Twitter guys and actually put little names above each one of those.
That's
right.
From big Market Huddle fans. Okay, so anyways, so for those who want to know, where can they find you, Patrick?
All right, well, so first of all, thanks for joining us all. If you made it this far into the show, we still have a great continued interview with Adam, so make sure you join us for the back half. But visit that markethuddle.com website to receive the weekly emails, which include the links to our show and the charts that we discuss. Rest assured, we'll never clog your email with junk. We'll only send you the weekly updates and the upcoming shows. You can follow our Twitter handle at the Market Huddle. And you can follow myself at Patrick Ceresna, and Kev, they can follow you at
Kevin Muir.
Right.
Well, that's terrific. Thank you very much for listening. For all of our American guests, have a great Memorial Day weekend. I guess that's what it is. An excuse to get out there and barbecue. That's how I know it.
Right, absolutely. And thank you very much, everyone. We got a great continued conversation with Adam coming up, so stay tuned. And otherwise, thank you all for joining us.
Thanks. Adam, thanks for sticking around with us. It's great to have you. As two Canadian boys, I must say I'm a little mesmerized by your accent. Where are you from, Adam?
Yeah, I'm from Mississippi in the deep south of the United States.
It's awesome, and I just kind of think it's funny that here we have a very sophisticated kind of financial trader in Mississippi. How did you go to business school?
No, absolutely not.
So I like that answer. No, I didn't.
No, I mean, how I got started is that I was interested in finance in high school and in early college, and I was originally a computer science major, and then I transitioned into finance, but I think it was my sophomore year, and I was like, hang on, I don't actually know if I will be happy with like the day-to-day life of this career. And so I was like, let me put a pause on this degree. Let me go actually try it out. And if I like it, I'm going to finish it. If I don't, I'm going to pivot. And so in that year off, I found a CTA that needed some help. And I was very happy with that job because it wasn't like some, regular internship of, light work, like get people coffee. It was truly a thing of like, I'm going to teach you how to be a quant and like design a model. And so I did that for a year, like fell in love with that, went back to college. I went to Ole Miss. It's the big like state school down in Mississippi, and then got a degree in financial management. And then I started my RIA the day after I graduated. So it was a very quick transition.
Nice.
Well, that's great. Okay, so you got some charts that you brought along and that we didn't get to because you gave us a lot of stuff. So why don't we dig into some of them, and why don't you tell us what's on your mind?
Yeah. So what this is, I actually haven't published this post yet, but the whole point of this chart is showing, for people listening, just audio, it compares two things. One portfolio that it's just like a regular 60-40 US stocks, US bonds, and then another version of that portfolio that carves out 5% exposure to gold. And I'm showing this chart not to knock gold or anything like that, but here's what I do take issue with, is that in not just the gold community, but a lot of like alternative investments, they're typically pitched as sort of like an after, which is, you need to have some, so just sock away, 2 to 5% of your portfolio in it, and it'll be there when you need it in the future. And the reason why I take issue with that is because the data is quite clear, and that a 5% allocation doesn't matter. Like, so for those looking at the chart, the two lines that shows the performance between the regular 60-40 and then the 60-40 with 5% gold, it's the same line. There's no difference. And so while it might help you sort of like sleep better of having a small allocation to be it gold or like liquid alternatives or whatever, it doesn't matter. So if you're going to make these sort of different allocations, you should either do it in size with like a substantial allocation, or you should not do it at all and like save yourself the fees.
That's great. You know what? I was just like, you mentioned Ole Miss, so I must admit, while you were talking about gold and changing the stuff, I realized Blindside, is that not from is that from Ole Miss? Is that where they went?
Yeah. So that player, he played at Ole Miss, and Michael Orr guy. Weird story. One of my roommates in freshman year, they was like close with that family, and yeah, basically Blindside big in Mississippi and Memphis, Tennessee too.
So it's all true.
Oh yeah. That's all accurate.
And so where you and so you had a friend that was his like a pal or a roommate of his. Did you go drinking with him?
No, I never went drinking with the football player himself. What it was is my friend went to the high school in Memphis of where that guy came from, and sort of like got his first start in football that sort of led to Ole Miss, then NFL. And anyways, but yeah, no, all that story is completely true.
Oh, that's a terrific story. Okay, so let's go on. So the gold, you should, if you do it, I like that kind of conclusion that if you're going to do something, you do it in size. Yeah. Let's go on to the next chart. What do you have here for us?
Yeah, so this is a little bit more like longer term stuff than the stuff I know I've read from both of you. But what I'm getting at is when it comes to like the ETF world and like the whole financial advisory world, products like smart beta stuff and factor funds are very popular, right? They sort of imply that a portfolio edge is a mouse click away. All you got to do is tilt towards, value, momentum, low volatility, et cetera. And all those products like smart beta and factor funds, they're pitched as satellite allocations to a core portfolio, right? So it's like, have your S&P, but layer on some value, right? And so what this chart shows is two portfolios. One, which is a very basic 60-40 on the right-hand side. It's got 30% in U.S. stocks, 30% in international stocks, and then 40% in bonds. It's like a super low-cost Vanguard portfolio. The one on the left, think of it as like the ultimate slice and dice. Like you're putting some money into value, you're putting some money into small cap, gold, REITs, tips, floating rate, et cetera. And the whole point of this chart for audio people not listening is it's the exact same portfolio under the hood. On the surface, very different, right? Like you've got all these minuscule allocations. But the truth of it is that when you never sort of have conviction to sort of put a big allocation to a truly different asset class and you sort of sprinkle a little bit of this and a little bit of that, it aggregates up to the exact same P&L profile. And so here's the issue: is the reason why people pursue portfolios on the left, like financial advisors, is because it looks like you're doing something. Like somebody looks on their statement and they look on their statement, they're like, oh my God, look at my advisor. He's got me on all this stuff. He's obviously very smart, and this is going to give me an edge. And the truth of it, the truth of it is that it's sort of seduction by complexity, and it's throwing the wool over the eyes of people who don't see the portfolio for what it really is.
So, Adam, for such a young guy, you have wisdom beyond your years. I have a question for you.
Yeah.
Are you able to go and actually sell people on the right-hand portfolio, that of 3 positions, like a typical 60-40, or is there a huge pushback on that, and they want the complexity, they want to feel like you're doing something?
Well, first off, I appreciate the wisdom comment. I still have a lot to learn. But when it comes to the what sells, what doesn't, I'll be very honest. Like when I started, I was way more the left than the right. I had complex models, complex allocations, and that sold very well at the beginning because everybody with all these active managers, they implicitly are betting of, this guy's got the secret sauce. And as time changed, I just took a really hard look at what works and what doesn't work. And let me be clear, I am not investing people in, fully passive 60-40 portfolios because the truth of it is you can go do that yourself. You don't have to pay anybody. And so when it comes to how I manage money, I'm effectively 50-50 active passive. The 50% passive is very similar to what you see on the right-hand side. The 50% active is I don't call it proprietary or anything. I literally put my entire strategy on my website. It's movement.capital/strategy. I run 2 active models. One is focused on the probability of recession, and it scales equity exposure accordingly. The second one is a trend following model. And basically, as long as the trend for U.S. stocks or global stocks is positive, overweight; if trend is negative, underweight. And let me explain too. When you evaluate an advisor, you have to look at them from sort of I think 2 angles. One, which is the cost of entry. What is their fee structure, right? And then 2, which is what is their implementation cost? What does it cost you to run their strategy? And so for me, I sort of made a business decision a year or so ago, and I started like everybody else. I was charging, 1.5% of NAV, and I looked at it, and it didn't strike me the right way because I would have one client with, let's say, $1 million portfolio than another client with $100,000. I was charging one person 10 times as much, and I was doing the exact same amount of work. And to me, it didn't resonate with me, and so I changed my billing setup to flat fee. So I don't care what your portfolio size is, I'm charging you the exact same amount for investment management. And full disclosure, I charge $3,500 a year for that. The margins for financial advisors, it's in the planning, as it should be, because financial planning is the thing that's either really simple, like let's say somebody's 30 years old saving a bunch of money. There's basically no planning. They just need to save as much as they can. But for somebody who's recently retired, and let's say they're concerned with maximizing the tax efficiency of their portfolio withdrawals, and let's say they want to set up college plans for their grandkids, there's more work there. So therefore, that's where I should get paid more because I'm having to work more. And so for me, I know that was a tangent, but when somebody comes to me, I make it really clear that what you pay me needs to scale with how much I work, and not necessarily how many positions are on a statement or the size of your account.
Yeah. Adam, that's interesting. I just went out with an old friend the other day who works at a family office that he's recently come back to Canada. He's working at this high net worth family office that tailors their their services for really, really rich people. And they actually don't work on an AUM basis at all. They're very similar to you. They just say, we think we're going to, spend X hours on your portfolio, and therefore we're going to charge you Y.
Yep.
And that's how they work it all. But one of the things when you mentioned that you said something about your proprietary model for estimating what the probability is for the economy going into recession.
Yeah.
Where do I find that? How do you want to talk a little bit about that? I'm curious what your model's saying right now.
Absolutely. And so, I want to make a point too. It's definitely not proprietary. If anything, it's open source. I put out the whole model on it's movement.capital. movement.capital/strategy. There's no .com or anything. So it's movement.capital/strategy. And if you want to dive into I call it the macro model. All it does is it scales a client's equity exposure based on the probability of a recession. A portion of their equity exposure. It's not a binary thing of like yes or no. But when it comes to the actual,
I think I have it up here.
Yeah. So you click on that macro model link.
So choose the macro model on the right there.
Yep.
Yeah.
And so what I'm doing is I'm looking at basically 3 variables. I'm looking at retail sales, industrial production, and the unemployment rate. And these 3 indicators, it's sort of this, broad picture of the U.S. economy. You got retail sales looking at, health of consumers, industrial production, business activity, unemployment rate, which is the strength of the labor market. And for both retail sales and industrial production, I care heavily if those 2 indicators are negative year over year, right? Pretty much every single recession we've had in the past has been associated with contracting retail sales, a weaker consumer, or contracting industrial production. The unemployment rate is a little different in that I don't look at it on a year-over-year basis. I'll look at it relative to a moving average, aka whether unemployment is rising or falling. Unemployment rate, it's like this beautifully trending time series in that it's not volatile, it's not noisy. When it falls for multi-year stretches, and when it rises for multi-year stretches. And historically, recessions have always been associated with a weaker labor market, more people getting fired. And the way I sort of distill this down to positioning is it takes 2 of those things to knock me out a little bit of equity exposure. And so, for example, in what was it, late 2015, early 2016, industrial production was negative year over year. We had that very mild, manufacturing recession. But at that point in time, that was it. Like the consumer was pretty healthy. The labor market was strong. So therefore didn't pull out. But in periods like 08, 01, et cetera, when 2 of the 3 sort of like went negative, and you can sort of scroll down this page to see that, to me, that's when I went in and sort of like slightly lowered equity exposure. And so if you scroll down just a little bit more, let's see. So right here, this second table that's looking at, during recessions, outside recessions, think of it as showing you the probability of, okay, this retail sales annual change less than 0%. What percent of the time has that been the case, outside of a recession or in a recession? Basically, if retail sales have been contracting year over year, if people have been spending less money relative to the prior year, 70% of the time, that has been the case during a recession. That's only been the case 15% of the time outside of recession. You can see the different percentages for the different indicators, and it sort of sums up to me trying to get a higher hit rate on indicating, are we in a recession? Yes, no. And so this is the macro model. I'll rebalance it every week as the fresh macro data comes in. And you might ask, okay, Adam, what positions is this actually applied to? This is applied to 50/50 U.S. international total market cap funds. Specifically, the ones I use are VTI and VXUS. Those are ETFs in the U.S. One is U.S., one is international. And if 2 of these economic indicators are indicating, okay, higher probability of recession, I pull exposure to those 2. But if they're positive, I'm in both 50/50. I don't sort of tweak the sizing between the 2. So yeah, that's sort of how I assess equity exposure based on the macro picture.
Adam, that's terrific stuff. As you're doing all this, I realize how important your kind of computer background is. And I've been a big proponent for young people. A lot of times I get young people coming to me and saying, I want to be involved in the financial industry. How do I go about doing it? And my kind of feedback is always, make sure you get good computers, because that's the one thing that you can't, when you're competing against the old guys like me or Patrick, is that you have an advantage. And that's how I got my job on the trading desk. Back then I knew Excel, which is like, just like stupid that Excel was, something that people didn't know, but, and it seems kind of quaint now, but I look at you and to me, you feel like the modern financial millennial, and I'm just like so excited by it.
That's not a compliment.
And I was wondering,
modern financial millennial, man.
No, I think that is a compliment. I really do, and I look at your stuff, and I look at your ability to do computer stuff, and I'm just jealous, and I really feel maybe you could talk a little bit about what you program in, what your advice would be to other millennials that are looking to get into the finance world, because obviously you have a very big computer science background, so you're probably more able to talk about, like, why don't you discuss with the, like, let's go down this road a little bit.
Yeah, sure.
What would you recommend to a young person graduating from university today that wanted to get into the financial industry?
Oh man. Well, what those people are going to do is they're going to, hopefully they would have looked before they graduated. They probably would have stumbled across a site like Wall Street Oasis, which, talks about how to get, a job in the financial industry. And the truth of it is this, is that, like, if you didn't go to a target school, like, good luck getting that first year, like, IB, analyst position. And which was sort of my case, which is I went to a non-target, like, regular state school. And the main thing I did is, when it led to, like, the computer stuff, is you have to be interested in your thing. So, for example, if you go out and let's say you buy a book that's, like, teaches you Python or whatever, and there's some exercise that's like how to build a Space Invaders video game, like, okay, you're going to see that and you're like, this isn't getting me closer to what I want to achieve with this skill set, right? And so to me, the thing that you immediately have to try is, like, try to solve for what you care about. So for me, I think we talked about, like, the hedging stuff. I had to get at least semi-literate with Python to be able to run that analysis, because that's immense data work of A, getting the source data, the option pricing, daily. B, as we all know, options expire. You have to splice together sort of that rolling time series. And so I would say two things. One, which is pick something to get interested in and solve it, rather than, like, being like, I want to learn this new thing and, like, watching Khan Academy videos, because it's going to be boring because you don't care about what they're actually teaching. And so I like to sort of, like, hack it together at the beginning. Then I'll say this, you sort of mentioned Excel, and you used the adjective quaint. I still do most of my stuff in Excel because it's really powerful. And, like, I don't think, people should dismiss it, because if you're good with it, you could sort of crunch numbers every which way. And so I still use Excel pretty much every day. And then I would say, I don't know what else. Here's probably the most important thing, is best thing I ever did was take a year off and actually sort of, like, put a pause in my life and say, okay, I've got this idea that I want to go into finance. And what I knew is I talked to people who graduated a couple years before me, and they're like, man, I got this degree. I loathe this job day to day. I wish I could go back to college, redo, have a different major. And so rather than, like, immediately assuming you want to be a master of the universe and, like, be in the next Market Wizards if it's ever written, like, and you're in college, like, take time off, try to land a good internship, and you really might look up and be like, this is not what I thought it was. And so you can only figure that out for yourself by, like, actually doing the work. So I would say seek that out, like, quicker rather than later.
That's some great advice, Adam. And one of the things that you say that Excel is actually more powerful and that we shouldn't dismiss it.
Oh yeah.
I actually agree. I was in New York the other day, and I kind of reached out to some people that said, anyone want to go drinking? And some younger guy that was a volatility trader, reached out, and we ended up at some bar in Chelsea or something. And he was he was a real quant. Like, I'm pretty sure his degree was in, like, a rocket scientist and stuff like that. And I asked him what he programmed in. He says most of it is Python. But he was laughing. He said that the front end of what he kind of uses to display it all is Excel still.
Yeah.
He says, Excel does a lot of really good things. And he talked about Excel Wings, which is kind of a Python library or something that enables you to use both Excel and Python together. And he was a big proponent of that. So just a question for you is, so obviously being good at Excel is kind of, I would say that's the bare minimum. Everybody should be, a young person should be good at Excel. Is it Python? Like, I know you do a lot of Java. I'm assuming you do a lot of, web development. Your websites are beautiful and they're terrific. And you must know a fair bit. Like, is that JavaScript you're doing? Like, is that what you taught yourself there?
Yeah. So all those charts is, it's a blend of, like, JavaScript and CSS. And it's honestly, That's not difficult stuff. Like, it's the same chart every time. It's pretty much like a layered line plot. So you got 2 lines at the bottom, you got a big line up top, and that was JavaScript. JavaScript's powerful in that you can make stuff look beautiful on the web. CSS is sort of not so much the charts, but more so designing the whole page. And I'd actually say this: if somebody was interested in making like pretty stuff online, I wouldn't go down the rabbit hole of teaching yourself like CSS and HTML, because 10 years ago, if you wanted to make a pretty website from scratch, you had to know the code. Nowadays, all you have to have is a good-looking WordPress template and a WordPress, website, which is free. And so to me, I would spend zero time like learning HTML or CSS. And there's a lot of JavaScript charting solutions that are pretty much off the shelf. I've like lightly tweaked mine, but I think that what I'm getting at is, regardless of like Excel or JavaScript or CSS, chances are the thing you want to make has already been made. So find it out and build on top of that, as opposed to like rebuilding from scratch every time.
Right. So then would you say that really Python is what they should be learning?
No, because so to be honest with you, my use of Python, I only defer to it if I need a lot of data prep on the front end. So for example, I did not use Python at all for this graph on the screen. This was all Excel. But for like that option rolling thing, yeah, that was a Python thing, because I had like 1,000,001 CSV files for like daily option pricing, and I needed to sort of like combine it all together into one big thing. And so I wouldn't even jump at, you got to learn Python. It's a big function of what you want to do. So if you want to put out these if you want to do like crazy work with like option strategies or like futures rolling stuff, yeah, it's like you should probably lean towards Python, because you're going to have a lot of data prep. But if you're doing really basic stuff, like I want to look at, market correlations or like how different portfolios have performed, you can do all that in Excel, no problem. So it's just up to what you want to do with it.
It's interesting you say that, because actually George Perks, I don't know if you know him from Bespoke Investments.
Yeah, his stuff is great.
He's the same way. Like, he's a terrific guy. He's also Canadian, and so I'm a little biased towards him. But I reached out and chatting with him, and he says, I'm learning Python, or I can't remember if it was Python or R, but he was learning one of them. And he says, but, the reality is I can do most of the things I want to do in Excel. Yeah. And, I think you're kind of echoing the same comments that he has.
Yeah.
But anyways, listen, do you have any other charts that you want to go through?
Oh, yeah, I do. I was going to push you on this, because I needed to know what's going on here on this 10-year Treasury bond chart here. What are you trying to show here?
Yeah, so actually, I brought this chart back because I remember months ago, I think either I shared it, Kevin shared it, something, and it got like a lot of engagement. And I think people found it to be sort of an interesting chart. And what it's showing is sort of the rolling 10-year inflation-adjusted return of a position in the 10-year Treasury. And there's very, very much, two discrete periods. There's the 1926-1981 period where, and this is a nut statistic, but if you would have been invested in 10-year Treasuries, you would have had a goose egg at the end of it, as in a real return of zero, right? And then ever since, rates sort of have been going down since 81. It's been the biggest bond bull market ever, and that's a crazy statistic, which is on the right-hand side. You can see the annualized real total return of the 10-year Treasury has been almost 7% real since 81, which is that's stock-like level of returns. And so this chart, the whole point of it is that most people, when they think bond exposure, they think boring, linear ride, and if anything, it's the opposite of that, right? And so I have this chart in here for a reason. If you go to the next, there's some context around it. No, keep on skipping until, let's see, go to the right. Perfect. Okay. So this is another sort of research project I did, which is, most people with their regular portfolios, they got some stocks, they got some bonds. And I wrote this post because I think that people's expectations for bond exposure are too optimistic. Basically, since the year 2000, bonds have done extremely well whenever the S&P has gone down. And what this chart is showing is every single 10% or more correction in the S&P since 1987. And so you got the magnitude of the correction on the left, then you've got the change in, 10-year yield basis points in the middle. Then on the right-hand side of those numbers, All that is the performance of different bond asset classes during that correction. And if you look at the change in 10-year yield, you can see this sort of relationship that started in the year 2000, which is pretty much every time we've had a correction since then, yields have come down, bonds have risen, and bonds have like massively diversified stocks. They've helped out a lot, right? The point of this is to show that that is not the norm. Before, from like 87 to 99, more often than not, yields actually rose when stocks had a correction, meaning that bonds, stocks cratered and bonds didn't bail you out. And another part of this chart that's important is I think people have been sort of seduced by taking more and more duration as this bond bull market has continued. Like it's sort of like a Pavlovian thing of they've always been rewarded for if some duration is good, more is better. And what this shows on the that very bottom line is that long-term U.S. Treasuries, specifically this is for TLT, it's got a duration of 17. They've averaged an 8.6% rise when the S&P has fallen 10% or more. But that performance is concentrated in the post-2000 period. Pre-2000, long-duration bonds did not help you out. In fact, they did even worse than intermediate-term bonds during when the S&P is corrected. And so I think there's another chart, either go to the right or left. I don't know the positioning of it. Okay, so this is an awesome chart from GMO, which is you might see all that data of like, okay, since 2000, bonds have really helped. Before, they didn't really bail out equity investors. Why is that? Like, what happened in the year 2000? This is not a novel point. Very smart people like Chris Cole, whatever, they've all noted this, which is the relationship between the correlation of stock and bond returns really changed around the year 2000. And ever since, bonds have been a lot more negatively correlated to stocks. And obviously, if you have a portfolio and you combine two assets with negative correlations, that lowers volatility and it means they diversify each other more. And so to me, people might think that's the norm for bonds to sort of zig when stocks zag. That's not the case. You go back to 1882, on average, they've sort of exhibited this mildly positive correlation of about 0.2. And the takeaway, this isn't all, information for the sake of it. The takeaway is this, is that if you've got a portfolio and you got equity risk, you got bond risk, okay, the past 19 years have probably set too high of a hurdle for both the level of that portfolio's volatility. It's probably been lower than average because the correlation's been negative, but then also, in a year like 08, when like long-term treasuries ripped, you can't always depend on them to do that. And to me, I think Kevin and I have actually talked about this, which is, bonds aren't the thing that they used to be when it comes to their ability to outperform in a substantial correction. And so I just think people who are running portfolios need to sort of like rebase their expectations to the more normal relationship between stocks and bonds.
All right, so Adam,
Okay,
I'm coming in here, Kev.
Stop
right here.
No, Patrick.
Stop
Patrick,
right here.
Before you say anything, I got to tell you something, Patrick. I've been sitting here. It's Kevin speaking.
Yeah.
Biting my fist because I am got such a big smile on my face. Adam is my people, man. I wish I could have articulated that as well as Adam did. That was the best argument I've ever heard, and I just think he did such a terrific job.
Oh.
I actually think, Patrick, you just you might as well just give up. Like, don't even argue it. Argue it, buddy.
I was gonna say. No, Kev, this is to be continued. Now, so Adam, Kevin and I are going out to Chicago to the Trader Expo there, and we're going to be speaking there, and we're going to throw the gloves down on the bull-bear debate on bonds. And
Patrick,
I assure you that he's going to be pulling your charts out in
exactly.
this.
I actually might just recruit Adam to come and do my job for me because he did such a beautiful job. This is
and I am not going to say another thing. I am saving it. I'm saving it for the stage.
I just thought, Adam, that was. So go ahead, bud.
I don't want to label myself as necessarily a bond bear because I do understand the other side. Demographics are destiny, yada yada. We can sort of repeat. We can be JGBs for the next 20 years, yielding zero. I get that. What I'm talking about is the fact that, okay, so for bonds, to generate this sort of monster portfolio boost in the next recession, you have to have rates go to sub, June 2016 levels. And to me, in sort of investing, it's a game of probabilities. To me, that's probably not a high probability scenario. And it's not necessarily that, bonds are going to reverse and we're going to completely undo this bull run in bonds, but it's sort of like there's just less meat on the bone of what they can do.
Yeah, bingo. It's like,
oh my God, I am.
1 second. Adam is right, because for the past 30 years, real rates have been substantially positive, and there's been a lot of room for the compression. But anyways, let's save it for the Traders Expo. And just for everyone knows, it's John Netto is actually is moderating it. Does he know what he's got in store for him?
He has no clue.
No, Patrick,
we're actually going. We're going to be bringing him actually onto the Huddle in the weeks prior to that. I think we're going to have to squeeze him in July sometime so we can warm up our listeners to this. But it'll be good.
So,
it'll be good.
I'm gonna end there because, Adam, that was so terrific. I just feel like anything else would spoil. It's like Michael Jordan sinking the basket, and just like anything else would be like coming back and playing for the Wizards. Like, I think we should just like stop right there. So, Adam,
Fair enough.
last time, where can people find a little bit more about you and your firm, and if people want to contact you and talk a little bit more about the correlation breaking down between stocks and bonds in the coming years, where would they find you?
Yeah, so Twitter is @movement_cap. My email is adam@movement.capital. And then the firm website is movement.capital. There's no .com or anything. And like I mentioned, I put all my strategy stuff out there. So if you're like, how is he positioned right now? I'm transparent with it. So at movement.capital/strategy, that's literally outlining the model positioning and what I'm allocated to at the moment.
Well, terrific. It's been a pleasure having you. Adam, it's been so tough because everyone I get on is one of Patrick's disciples that's always so bearish and stuff like that. So it's been a pleasure having someone that thinks somewhat similar to me. Thank you so much for coming, Adam.
Yeah, I've thoroughly enjoyed it. I appreciate it.
Thanks a lot, Adam, bud.
I was going to say, when you guys brought up the whole first slide with the picture and, do you think people are going to find this offensive? And then I started to think, I'm a few beers in now, and I'm looking at it and I'm like, I looked at this multiple times and it did not occur to me whatsoever that this could be offensive. Like, is there something wrong with
Lena,
me?
first of all, you don't first realize what that is. This is a scene from One Flew Over the Cuckoo's Nest.
Oh, no, I recognize the scene, but it's at the same time.
Oh, you do?
Yeah, that's why I was just like,
I'm
I don't know why
surprised.
it would be offensive. So that's why I was like,
it's at a mental institution.
But no, I get that. That's why I was just like, oh my God, is this so bad that I don't find it offensive? Like, why was it put in there?
Kevin is just so conservative. He's just so worried in this that somebody is going to. But you know what? It's after that one Game of Thrones WTF video that you suddenly are now worried that
the guy told me I was dark. That I was dark. I had a dark soul or whatever it was, and like from then on, I was worried. I had a dark soul, and my humor was too dark.
Oh no, your humor is just the right amount of dark.
Oh, well, you know what? That's a few beers into
That's
it.
true.
Lena.
I'm
and
pretty
all I
well
can say is
stocked,
congratulations for drinking more than Patrick. I do appreciate that. Anyways, I got to split, guys. It's been great. Thanks a lot. Have a great weekend, everybody.
All right. Take care, everyone.
Bye-bye.